Hello everyone, welcome back to the channel. So I saw a few comments asking about how the portfolio looks like. So yeah, this is how the current portfolio looks like. And in today's episode, we'll be doing something that is slightly different. So I'll be running through the macro picture first, and then we'll go into individual companies. So as you can see, this is how the market performed over the past 1 week. The semis play is still relatively strong. You're seeing oil prices going down, hurting your oil companies. So we've seen the Iran and Israel war concluding. Although now there's news about the Straits closing again, we'll see next week. But the semis play is still relatively strong. So a lot of your flows are going into your semiconductor plays. A lot of it is actually coming in from leverage. So if you read some of the research reports, a lot of the new money coming in is actually from leverage. So monitor that. Okay, so we'll talk about Kevin Wash's FOMC meeting first. So for Kevin Wash, what he did during this meeting was he tried to push 3 different key mandates that he'll be going for as the Fed chair. So first of all, he said that he'll be removing sort of like hand-holding. So he's removing forward guidance. He is not in approval of the Fed dot plot. He doesn't want the Fed to be signaling to the markets. He wants it the other way around. So he wants the markets to signal to the Fed so that the Fed can take actions from there. Second of all is that the data that the Fed is using today, a lot of it is outdated. So I think during the press conference as well, he mentioned a few things to hint to the public that the Fed is still currently outdated, like using pencils or something along the lines of that. So this is basically him signaling to the markets that he'll be making changes, although the markets are confused as to what changes that would entail. And then third of all, I think this is the most significant one. Kevin Wash, during the interview, he repeatedly mentioned the Fed comment, which is that we're still away from the 2% inflation that the Fed is trying to push towards, and that they'll be actively correcting it. So every time there was a question on forward guidance, this was what he said. He said inflation is going to go down to 2%, and he will make sure that he does it. So what that implies is that rates will likely stay higher for longer, because you had a jobs report the other day as well, just signaling that the labor market in the US is relatively strong. Okay, so next part, let's talk about Microsoft. So Microsoft, despite robust execution, is down 3% over the past 5 days, despite the tech sector being an outperforming sector in 2026. So I believe the stock went up to around $470 and then it came back down again. And now year to date is down around 20%. Over the past 10 days, almost every single day it's been down. So we'll talk about Microsoft and what Satya Nadella actually said. So on his X account, he actually made like a whole blog explaining his point and explaining Microsoft's current position in the entire AI ecosystem. So what he actually said was that a frontier model without an ecosystem is not stable. So what he's actually implying is that the other companies, like for example, OpenAI, Anthropic, Google, all of them are actively trying to chase your frontier AI model. But what he's saying over here is that a frontier model without the distribution, without a platform to distribute it, is not sustainable. It is not profitable. So in one sentence, what he's saying is that the distribution of Microsoft is a moat. The frontier models will likely be commoditized in the future because all your companies are actively pushing towards it. But I think Steve Eisman, he mentioned something similar as well. He thinks that AI is a commoditized product because there's minimal switching costs between Anthropic's Claude, OpenAI's ChatGPT, Gemini, Grok, some other models as well, like the Meta ones. So yes, this is what Satya Nadella said. So what Microsoft is trying to actively push towards today is a model agnostic model. So they're incorporating models from China as well, which provides lower cost for consumers. And what they're actively doing is they're trying to insulate themselves from commoditization. So Microsoft is shifting away from a proprietary model system towards providing sort of like an infrastructure and a distribution system, which is what the company has been successful in doing. And then second of all, Microsoft is also trying to position itself as sort of like an infrastructure monopoly as well. So it is only one of the 4 companies globally that's able to spend so much money on AI infrastructure. And this is the path that the company is actively trying to push towards. Next portion, let's talk about some unorthodox ideas. So first of all is this company called Shamos. So yeah, they produce this thing over here, which is Opteon. So if you don't know what that thing is, it's sort of like a coolant. So your refrigerators, you need this thing called Opteon. It used to be CFCs, which is your Freon, but currently they're pivoting towards Opteon, which is this thing here. So Opteon is a refrigerant that cools things like, for example, your supermarkets, like for example, your cars, like for example, some of your aircrafts as well. But more importantly, this product is actively being used in data center cooling. So data center cooling, you have two different types of cooling today. You have a one-phase cooling as well as two-phase cooling. Two-phase cooling is what Chemours is actively trying to gain share in. So in your data center chip cooling industry, most of it is currently still single-phase cooling. So single-phase cooling means you soak the chips into like a liquid and then it cools from there. Two-phase cooling is when the liquid actually boils, and this is what Chemours is dominant in today. So this is unorthodox idea number one. It is benefiting from your AI data center infrastructure build out, and industry players will eventually have to pivot away from single-phase cooling towards two-phase cooling, because single-phase cooling, you're just cooling, you're taking heat away. But for double-phase cooling, because you're boiling, there's something called your latent heat of vaporization, which will take in even more heat as well. And as your chips increase in the energy consumption, more heat is going to be generated, and that's where a company like Chemours comes in. Okay, unorthodox idea number two. This is SK Telecom. So SK Telecom is under this parent group. I'm sure everyone knows it is SK Hynix, the SK group. So yes, this is a telco company. It's similar to Singtel in Singapore. It's a boring, but there are a few hidden gems in this business that I think a lot of people are missing today. Okay, so first of all, they own a portion of Anthropic, and that portion of Anthropic at $850 billion market cap, assuming that is Anthropic's valuation, is around 30 to 40% of the company's market cap. So if you were to discount that portion away, that means that the remaining telco business is trading at 5 to 6 times EV to EBITDA. Okay, that's the first part. Second part is this. Second of all, this company is actively trying to become a neocloud in Korea. So you have your neoclouds in the US, like for example, CoreWeaves. In Korea, this is what the company is trying to do. So they're trying to buy in all the chips from NVIDIA, and they're getting your memory chips as well from SK Hynix, of course, because they have priority under the same group as well. So that portion is currently around, I believe, 5% of the EBIT of the company. So it's still relatively new. It's a segment that's grown 89% year on year, and the streets are missing this. Second of all, you have your Anthropic stake, which is around 30 to 40% of the market cap. I'm not sure if the management will monetize it when Anthropic goes public, but you can view it as sort of like an Anthropic proxy play. And third of all is that they have a stable telco business that is doing quite well. They had a security breach last year, but they've recovered, membership is growing, and they have around a 40% market share in Korea for your telco business. So for Korea, in telco, you only have 3 different businesses. SK Hynix is the strongest one out of those 3. So this is idea number 2. Idea number 3 is Honeywell Aerospace. So Honeywell is undergoing a spin-off on the 29th of June. It's coming up soon. So keep this in mind. The stock will probably sell off because of institutions needing to sell the stock because it doesn't meet the market cap requirements anymore. So bear in mind. But for Honeywell Aerospace, I think this business will spin off at a valuation, an EV to EBITDA valuation of around 14 times. So the market mean is around 18 times. So that's a discount assuming this price holds. And yes, your aerospace industry has produced quite a number of successful spin-offs. So for example, you had GE Aerospace. I'm sure everyone knows that one. And then you have RTX as well as Carrier Group and Otis doing quite well as well. So overall, spin-offs are a place for you to find hidden gems. And I think Honeywell Aerospace is probably an interesting idea. Spin-off is coming soon, so keep this in mind. Okay, so this is the 4th unorthodox idea, and this company is Amright. So it looks like an extremely boring business. I mean, it looks like a trucking business based on the picture, but no, it's not. This company is actually a basic material business. So they sell cement as well as aggregates. So cement is a relatively commoditized business, but I think there are some hidden gems in there that you can look out for. And the reasons why I'll explain later as well. Aggregates is also another business that is fantastic if you're able to find companies within that space. So there are competitors to Amright that are doing quite well. There's this company called Martin Marietta Materials. I think the ticker is MLM. It's an amazing business. And then you have Vulcan Materials as well in this aggregate space. Okay, so I know cement as well as aggregate doesn't sound sexy, so it sounds like a boring business. But the reason why your cements and your aggregate businesses, they do so well is because of a single factor, which is something called a geographical monopoly. Why is there a geographical monopoly? Because cement and aggregates, they're heavy. So if they're heavy, what that means is that transportation cost is extremely high. So maybe let's say I want to build a building at Bugis, and then let's say the cement plant is next to me at Bencoolen, for example. And then if let's say that Bencoolen plant is charging me $10, and then let's say there's another plant elsewhere at Pasir Ris that's charging me $1 for the cement. But the transportation cost for me to bring it over is another $15. So then naturally, of course, I will pay up for the cement in Bencoolen instead of buying it from Pasir Ris. So the idea is this: they have geographical monopolies and they have regulations preventing new plants from coming up as well because of this not in my backyard movement in the US. So that's the moat for these businesses. They are geographical monopolies. They're doing quite well. They have immense pricing power for the aggregates business as well. And if you're able to find those companies, I think Amrice is one of them, that is able to move all the plants inland. So inland meaning move it towards the central area of the US. So then you have a geographical monopoly with pricing power. I think it recently just spun off as well. Hopefully it falls a lot more. The reason why it's been falling is because oil prices have gone up. But oil prices have since gone down. That's why you're seeing a slight recovery for this company, because in order for them to power the cement plants, they need oil. I hope you guys have found this video useful. Anyways, check out our Substack. It's the link in the description below, and I'll see you guys soon.